Today we saw a number of things happen in global markets, starting off with the ECB cutting their interest rate, which got things interesting on the gold side of things as well as the euro. And this morning we also saw some US economic data, which definitely spurred the markets. I'm talking specifically about the refinancing rate out of Europe, so they went down to 3.65%. They were at 4.25. This was largely expected, but still shows where the central banks of the world tend to want to go. They want to cut rates. And we can add on to that when we got into the jobless claims here this week. We saw 230,000 files for unemployment. And at the same time, we also saw the producer price index, which on a year-over-year basis, the headline number is 1.7 compared to forecasts of 1.8. That's pretty good, coming down from 2.1% year over year. Now, on the producer price index without food and energy, or core PPI, we actually saw 2.4% compared to the forecast at 2.5%, and this is actually largely in favor of the disinflation story working out well. We do see prices coming not down, but we see prices going up at a much slower pace, which is more sustainable and accommodable to the overall economy. In terms of a stock market reaction, what we see here is a bit of a mixed one. We saw an initial kind of blip higher, then push lower. Now at the time of recording, we've come back to about break even on the day. Not a huge decisive move either direction, but we'll get back to the S&P 500 in just a second. Let's continue by taking a look at the dollar index, which is trading modestly lower, and this makes sense, right? Inflation seems to be coming down pretty clearly. Both the consumer and producer price index this week showed us that inflation seems to be cooling off at a meaningful pace, in fact, faster than what was expected, which is arguably good news for the stock market, but not so great for the dollar. Remember that cooling inflation, what that does for the dollar, it tells you that, well, the Fed's going to likely cut their interest rate, perhaps even more quickly than previously thought, which remember that all you need to know on the fundamental side to keep it very simple, the Fed funds rate coming down quicker is bearish for the dollar because it makes foreign investment into the dollar less attractive. You may not see as much demand for bonds or US, interest rate denominated kind of investments because, again, it's offering a lower yield. Now, for people who need to borrow money, like maybe borrow to buy a house or do whatever they want to do, start a business, this is a good thing, right? It's actually a more hospitable environment when inflation is cooling off, interest rates can then come down and people can go out and borrow money a little easier. So this is arguably a good thing for the overall economy and good thing for stocks. I do think that, the S&P 500 has had a nice bounce back this week off of the cool inflation data that we've gotten. Is it enough, though, to get us to break through the all-time highs? Well, I don't think so. And I've been cautious on the indices for the month of September. I've talked about that quite a bit. I actually ended up adding another short position to my Nikkei 225 position. So yesterday or the other day, I tried shorting the Nikkei. I was a bit early to the idea, but we bumped up into this level of resistance that I've been watching for. And with the bit of rejection that we saw, I decided to pick up a fresh short position on this one with a stop loss just over the highs. Now, when I short indices, it's kind of rare when I do that, but when I do short indices, I like to be pretty cautious. I like to keep my sizing small, and I like to trail stops very quickly, even quicker than when I am long on indices because of the nature of indices themselves. I've discussed this briefly, but indices tend to fall fast and rise slow. So if you can catch the right drop, which I'm trying to here, it is brief. It is usually very quick, and then it has some sort of bounce. And so if we do get a quick blip to the downside, I'm going to be trailing my stop loss pretty aggressively and quickly on the Nikkei. So I am short on the Nikkei right now, looking for some downside on the indices in general. And why the Nikkei? Well, let me show you. On the EdgeFinder's top setups algorithm, it basically takes into consideration sentiment readings, technical readings like the trend, as well as seasonality, and then finally economic data. So when we look at the Japanese economy in general, it's not as nearly impressive, in my opinion, as the U.S. economy, for example. The U.S. economy is growing. It's still growing despite the slowdown in labor data. Take a look at GDP, and I'll show you that now. So we'll do a quick comparison of the U.S. GDP growth, which this is quarter over quarter. What we can see here is some very solid, consistent outsized growth from the United States economy. It's why it's one of the, world's top performing economies for the last, I don't know, forever. Not forever, but for the last many years. If I take a look at the Japanese economy, however, look at the growth here. It's not nearly as impressive. In fact, you have several quarters where we had, down kind of performance there. And then, we do see some growth here, but it's not nearly as quick as the US. So why am I pointing this out? Well, if GDP growth is missing expectations, denoted by the red colored bar here, which we've programmed into the EdgeFinder, it's showing that growth is not particularly attractive in the Japanese economy. And that's not a new theme. It's been pretty consistently for the longer term, a struggling economy, an aging population. And it's one that I just really don't have nearly as much conviction to the upside. Doesn't mean I'm a perma bear on the Japanese economy, but where it currently sits, and with an EdgeFinder score giving us a -7 reading, seasonality comes into play. So the month of September is historically bearish for the Nikkei. The trend to the downside that we are seeing, GDP statistics missing expectations. There's enough here for me to piece together a bear case on the Nikkei. So I have shorted the Nikkei with a stop loss above. And the reason I want to point out that we put stop losses on trades is we risk small. And if we're wrong, we just get out. If the market rips here, if the Nikkei moves higher, I need to get out of my position. By the way, this trade, as well as all trades that I take, as well as my team takes, can be found inside of our Discord channel. So every trade I take comes with my entries, my exit points, as well as my analysis behind each kind of idea that I put out. So I'm trading commodities, I trade gold and oil, I trade Forex pairs, I trade indices, I trade a bit of everything. I even trade stocks and options. So all of my positions are completely shared inside of the group. And of course, I'm trading on live broker money. So, no nonsense there. If this is something that would be beneficial to you, our sale is currently ending soon. We've got a 35% offer that is available, basically 35% off of our usual Discord membership group prices. So if you'd like some information about that, the first link in the description will connect you to a member of our staff who can give you information if you'd like to pay with crypto or learn more, or you can head over to a1trading.com/VIP and sign up there with our 35% off discount offer. The information can all be found in the description down below. Next up, we've got to talk about my gold trade, which is finally making a move to the upside.
It's been 84 years.
In fact, we're for the first time here in about, 20 days or so since I took this trade, able to start trailing a stop loss. And again, this was a trade shared inside of the VIP room. And so this morning I was finally able to trail a stop loss. I put my trailing stop just below 2,500 here on gold. And we're off to the races finally with this one. This one has been really range bound for some time. And I'm looking for, from here, basically to continue trailing anytime we put in a new higher low off of the 4-hour chart. Let me show you where I put my stop loss here. So I entered back, again, like 20 days ago. So this has been a swing trade I've just been holding on to. But I've been able to trail a stop loss into profit here. And with this big break today on cooling inflation, as well as the ECB cutting interest rates, I like the trade quite a bit. And if we do get a pullback into this area, although I don't have a signal from the EdgeFinder to add to gold, I'll be watching for one to potentially add more size to my gold long position. But for now, very happy with the P&L that I've got. So if I pull up GLD, we could take a look at how things are going here. And you can see we're up about $1,500, $1,400 on this gold trade, which is fantastic. And silver's off to the races too, up 3% today. And even oil, so commodities across the board getting a little bit of a bid here, up 2.6%. And some traders might be wondering, how far can gold actually go from here? And with us trading at an all-time high at the time of recording this video, I just want to point out that when it comes to all-time highs, trying to time the top of them is incredibly difficult. In fact, I put out this tweet where I was basically discussing how many all-time highs gold has actually put in this year. It may surprise you to hear that we've actually put in 27 and likely 28 new all-time highs on the price of gold. Now that is the closing highs, right? So at the end of the day, when we close, the market closes, we've put in almost 28 new all-time highs. And this was just a reminder to my followers that all-time highs are oftentimes bullish. You'll hear people on social media say, oh my gosh, you're buying near the all-time highs. What's wrong with you? But if you're a momentum trader, you often know that this is true. Oftentimes, new all-time highs are preceding newer all-time highs, and higher prices are usually a bullish thing. They show that there's clear demand for an asset, an instrument, stocks, etc. So gold is up at this point. I just want to remind people, gold is up 23.5% plus this year. That is fantastic. It is actually outpacing the S&P 500, and it has been my best trade this year, has been long gold. I've bought in several different instances and made the majority of my trading gains. A lot of them have come from gold this year. I actually don't know if it's majority or not, but a ton of the gains that I've made this year in the market have come from actually just being long gold, buying dips and holding on and trailing stops. Again, the idea basically being that all-time highs are coming because the Fed's cutting rates, other central banks are looking to cut rates. We see uncertainty in the world, and all of that sounds like a very good environment for gold longs on a fundamental basis. So the S&P 500 is also sitting right around where I trailed out of my stop loss here. I'm not going to lie, I was feeling a lot better when this thing was dipping quite a bit. But, it is what it is. It's come all the way back to where I stopped out of the trade. But fortunately, I've been trading other things and made some money in other places. But I would be happy to see the S&P 500 give us another dip, because then I could potentially look to buy some stuff that I've wanted to or trade some options plays. Many of you may know that I like to sell puts when the market is selling off on stocks that I like. So when the market's moving up, it's a little bit more boring unless I'm long indices. But right now, I'm currently not in any long positions on the S&P 500, NASDAQ, or Dow, so none of the US indices. I just have that one short position on the Nikkei. So where are we at? Are we bullish? Are we bearish on the S&P 500? Well, I'll say this. From a seasonality standpoint, from an impending election situation, I kind of lean neutral to slightly bearish for this month. However, inflation is cooling. Jobs data is not horrible. The growth in the economy is still strong. So I would actually say that going into the end of the year, I definitely want to look to be long indices, but I may still be looking for trying to time some entries, some pullbacks, and trying to be, kind of patient on this. But not going to lie, yesterday was a little bit of a heartbreaker for me, because yesterday this market sold off and I felt very smart that I trailed out of my stop loss, or trailed out of my long positions. I bought the dip over here, trailed out here, and was feeling really smart about it until the market ripped back up. So I would prefer it to go down, but doesn't matter what I prefer, and it shouldn't also impact anything you're thinking about when you're looking at the markets. It doesn't matter what you think or you feel or whatever. The market does not care. Inflation's cooling. It looks strong. So this market may just continue to chug higher. That being said, seasonality still comes into play. I'm a bit cautious about the election, cautious about seasonal times in the year. And if you don't know what I'm talking about, let me show that chart. So seasonally, the S&P 500, I've shown this chart 74,000 different times, but September is historically a bearish month for the stock market. Doesn't mean it has to be. It doesn't have to be bearish, but it is something to factor into your analysis, and that's why it's not one of the top setups currently on the EdgeFinder. You can see I filtered for metals and indices here for just a second to keep our list short. The S&P 500 is sitting at a confident neutral reading. Same thing with the Dow Jones, the DAX. If we take a look at the Russell, it's still at 2, and NASDAQ's only at +2. So no bullish or bearish readings on the US indices here. And so I just kind of stay on the sidelines. If the market sells off, I may look for some opportunities to sell puts, etc. But I'm just going to try and stay patient here, and hopefully that patience is rewarded. If not, if the market just rips higher, I'll look for appropriate chances to enter and ride the trend higher if it does form. But again, we will have to see. There's plenty that could at any point cause some jitters in the market and some sell-offs, at which case I would look to take advantage. Reminder, guys, that VIP discount that I mentioned earlier, the 35% off sale, will be ending soon, so make sure to use the first link in the description to get access and come join the group. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this if if you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign-up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now, you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.